right, let's check out what's happening today on the markets. I think a great deal will go on today. If I show you this, so last night there was a massive bounce on the US markets, and the Australian market is following. The VIX is not down as far as you would expect, so that's weird. It's like, for that kind of recovery you would expect the VIX to go down even more, but I don't think it has. Yeah, so the S&P went up by 1.8%. The Aussie market is not going up by as much. It's going up by almost 0.8%. And the Aussie VIX is down by 2%. So the way that looks on the portfolio is there's been a spike in my margin, as you would expect, and the condor that we put on yesterday now doesn't look particularly good on the calls side. On the put side, it looks great. That's sort of offset by the insurance contract losses. So basically, not something you look at because that will just accrue value over time. It's not something that you're supposed to be closing tomorrow, like the day after you set it. The delta of the calls has doubled effectively, so from 5 to 10% overnight, which is sort of what you would expect with that kind of move. And you can get a handle on, just how much the price has changed. So the price has gone from the open of 11 up to $20, almost $20. So that's where a lot of that is coming from. Now, this is a classic example of like no one really expects the market to go up. Apparently the Fed in the US is like less hawkish. Maybe they're not going to start raising rates this month, might be next month potentially. We'll see what happens. So all of those things affect the insane traders on Wall Street. I think, so I don't have to do anything to that. There's the simulated account here with the more aggressive strategy is basically in the same boat. The margin's gone up. This is where you need to consider margin offset. So total margin in this account is now at 48,000 and the account cash is at 57. If that continues to go off, I might have to consider taking some offsetting action to reduce that margin in the context of what's going on here. I know that my margin requirements will go up towards expiry. So if this is in profit, I might just close this condor as a result of that situation. Because this is a simulated account, you don't get margin calls. So that's one thing that you really need to be aware of when you start moving into live trading, is that margin interaction on your psychology and also just on the practical day-to-day of managing it. And if you don't have cash to call on to put into the account, it can become a problem. There are tactics and strategies you can put in place to offset margin without having to close your positions. The reason why that margin would potentially be a problem is if it's going up and up and up, is that I don't have any bought calls further out of the money on the top side of the condor. Don't really want to do that because those things generally just lose your money, but might be required at that point. You could do the profit and loss analysis on specific contracts at the time, but we don't have to do that yet. Probably we'll start looking at that if this continues to go up. We're at 7172 and this starts to lose money on the calls for March, 14 days. They're at a delta of 10, so the market's not exactly expecting them to finish in the money, and they're still in a profitable position so yeah, we'll see what happens on those. And then on this account, this account here, I've only have one condor open and I need to open my next set for April. The market has gone up today. In a situation like this, I could potentially, there's two choices. Like I can open a whole condor because volatility hasn't gone down much. But there might be a pullback overnight, and I've still got a bit of time on my side before, that 5 to 7 weeks away from expiry. I'm still on the edge of that, so I could probably afford to wait a day and still not affect the profitability I can get from a condor. So what I might do is I might open the calls for one side in this account, open the calls further out with this increase. If the market holds where it is tomorrow, I'll open the put side. Otherwise, if the market falls, it enables me to push those puts further away to just give me more space. So to do that, I'll start a new strategy here, chuck in the code. I might use the cookbook just because I'm lazy. Now, one side of a condor is called a bull put spread. Where is that? Bull put spread. Here we go. Oh, sorry. I want the call, bear call spread. So I set my expiry, 49 days. You can set European or American expiry. Doesn't really matter because the only ones you can buy on an index are European. We only ever want European. And then I can set my bought and sold positions. So I need this to be a delta of around 5. Ten to 1. Credit to margin. That's looking a bit out of whack, but I might actually set it there, because if the market does go on a run, that 25 points apart is actually quite helpful. So 50 contracts, 750. Yeah. So $651 credit. Let's check this. Okay, now I'll put the trade through. I usually just put it through on the midpoint of the market. Theoretical price is $1.60. We're only it's just clocked over 10:30, which means we're only just in the time when options contracts can be traded. They can't get traded in the first 30 minutes of the day, or 20 to 30 minutes of the day. So we'll see. $800 credit, $99 to put the trade on. Total cost in margin, 7,000. Just double check these. April, the right expiry, the right type, calls. I'm going to sell 50, 25 points beneath my insurance or my bought other side. That's correct for the call side. It's flipped for the puts. Place that order. Wait a second, order's placed. Now we'll leave that in there for a while. See if we can get filled on the top. Sorry, further away from the theoretical price. If we can't, we'll just move it closer to the money, closer to the market offer for that. Cool. That's the trade update.